if we go over to the S&P first, so that we got a little pop. Now the real question is going to be: is that can we get anything behind it? So let me put this up. So let's see. Where did this go? So you have the test. So we got the test. That's good. So the last 10-minute spike, folks, we had 54,000. Now if you're looking at the S&Ps, we just got inside it. Is it 1957? Once you're inside 1957, you can get game up to this next spike. So if we go over to the NQs again, the NQs are at 57. Now this gets interesting because you see the difference? Now we just brought up the S&P, and now I just brought up the NQs. And I like to match them, but I don't see the spike inside the NQs. So that brings my probability. I need a spike in this thing. I need this thing to get inside 42.58. I give it a few more minutes.
Just hit 42.58.
Oh.
I'm just testing.
Oh, good. Okay. No,
as you were saying
good.
it was ticking there.
That's good. So if we go over to the trade for a second, because see, I can sell half of these and then have no risk, I think. It really depends on the 63.
So why don't we go over, just since you had pulled it up,
okay.
When you were looking at, so the spread goes from 42.50 to 42.90.
Right.
We're trading at about 42.80, let's call it, in the underlying, in the Tech 100, as we were going over that trade a couple segments ago. And so you were saying maybe the premium would stay in there, right?
Yeah.
And so I was saying, I don't know right where we are.
Right.
And so as we can see, the Tech 100's gone up about 7 points.
Yep.
And that spread has only gone up about 4 points.
Right.
And that's, Darrell's talking about the delta. That's, you're so far towards the end of that spread, either one tail or the other,
yes,
that you're not going to get point-for-point movement right from the get-go. And so that's where it's really important just to become accustomed to how that's going to move, because the last thing you want to do is be right in what you expect the market to do,
right,
and to be wrong in what you expect what you're trading to do.
No doubt. And then, and in that context, right, so this is what I'd be looking for. So right now, at 10 contracts, I'm up 310.
Yes.
Right.
So you had about
it's like I got $1,000 on, I think. Is it? Can we tell?
Yeah, I made about like $700 on that trade. It's pretty nice. I took my profit.
Yeah.
Yeah, you did risk about $1,000 for that, and that's because you're risking about $100 per contract with a $300 max profit. Yeah.
Right. So the key would be, folks, is to get half of those off. Because, see, my risk is still pretty intense because you're under the strike price.
You have about $1,400 in risk.
Yeah, and it's not even at the 60.
Right.
Right. So that's kind of, I just am explaining to you.
That's it's not even at the 60. Yeah.
It's at 42.60, anything under 42.60.
No, 42.50 is the bottom of your spread you're trading.
Oh, cool. Oh, that's even better.
So you have $60 per contract right now in intrinsic value, you can call it, to put it in options. So you'd have about $600 in value if that expired where it is right now.
Okay.
But right now with the premium, you have almost $1,400 in value. So that would be the extrinsic value, which is the time, the risk reward.
And that's where you want to watch that position value. Ooh, that's good. That's interesting. Yeah.
For sure.
Awesome, man. You stay right there, folks. Yeah, we're coming right back.
We're coming back.
That's a beautiful thing.
Right back after this. We got you.